Funding for the Stoller Report is made possible by a grant from the First American Title Insurance Company of New York. The First American Corporation is the nation's leading diversified provider of business information products and services that impact the major events of people's lives.
Hello, my name is Michael Stoller. I'm the host of the Stoller Report, Real Estate Trends in the Tri-State Region. The topic of today's program is residential developments, Condo-Mania, Insider's Perspective. My guests today include David Lowenfeld, Executive Vice President of Worldwide Holdings, Ken Horn, Principal and President of Alchemy Properties, Zeal Feldman, Principal of Property Markets Group, David von Spreckelsen, Vice President and Director of Acquisitions, Toll Brothers. David Sigmund, we have enough Davids over here. David Sigmund, Senior Vice President of Elcor. And the last David, and not least, David Kramer, Principal at the Hudson Companies. I like walking around the city. I always walk around the city, and I remember there were once parking lots. There were once hotels. There were once brownstones. And suddenly, there are no longer parking lots. There are no longer hotels, because individuals like all six of you sitting here have taken these properties and made them condominiums. There are no more, forget the parking lot, forget the Yonah Schimmel Knishes. The places are going. The bagel stores can't be around. What's happening? People like you take properties, or they take hotels. An individual like you takes the Sutton Hotel and moves it around. You buy a parking lot on 24th Street. You go into Roosevelt Island. You, the 800-pound gorilla of Toll Brothers, you buy whatever you want. So what's happening? What are we, in a city of condominiums? Mr. Horn, what's your opinion of this phenomena today?
Well, I'm not so sure I agree with you that it is a phenomena. I think that the concept of home ownership has always been very strong, not only in New York, but obviously across the country. And I think what all of us are probably doing is taking advantage of a situation because there's a market to be had on the other end. If there wasn't a market to be had, we certainly wouldn't be buying parking lots to build condominiums, nor would we be taking hotels and potentially converting them to condominiums as well. So to a certain degree, the left hand has to be in sync with the right hand. If we bought the projects and built the projects and there were no buyers, then certainly we would not be incentivized.
So there's a lot of buyers? I mean, Mr. Sigmund, and the reason I'm not saying David because I have all these Davids. David Sigmund, your company has entered into contract to buy two properties. One on a parking lot, a former parking lot on 24th Street, a Con Edison parking lot, and 6th Avenue, which now is very fashionable Chelsea. And then you've entered into buy a three-story building on the corner at the entrance of the Midtown Tunnel.
Yep. Former three-story building.
For a former three-story building where you're planning to build another tower. What's going on?
Well, I mean, we picked specific markets. The Chelsea market, and these are both good examples because the Chelsea market was rezoned in the mid-90s. And about 3,000 units of rental housing were built in the last 10 years, but no high-rise condo tower in that market. And we thought the timing was right, so we bought the Con Edison site. And on 34th Street, we think the Murray Hill market, the sort of Midtown East market, has been, despite all this activity, has been underdelivered. We think there's an undersupply in that market. The handful of projects that have been done were conversions, or they were rental projects that ended up being sold as condo. So we think there's an opportunity in that market. So it's case by case.
Speaking on the Murray Hill neighborhood, Mr. Feldman, a couple of years ago, how many years ago did you buy that property about 2 blocks away from David's?
A couple $100 a foot ago.
A couple $100 a foot. How many in daylight time? How many years was that?
About 3 years ago, when the Second Avenue Deli was still open.
So it was 3 years ago. You bought a rental apartment building which had what percentage of the building was rent stabilized?
About half.
So half of the building, this was 250 units, something like that? Well, between First and Second Avenue, right, not too far from David Sigmund's property over there. And did you buy it with the hopes of keeping it as a rental, or did you buy it with the definite thought that you were going to make it a condominium?
We had no hope to keep it as a rental. We would have been losing money on it.
But you know what? You've been on the show, and Ophir Denny has said you can make money in the rental business.
If you're a management company, you make a lot of money in the rental business.
Wait a second. Mr. Lowenfeld, you have a couple of rental buildings. Are you telling me that you don't make money in the rental buildings? Sure. I realize you worked for the government at one time in your life when you were Dr. Lowenfeld, but you're telling me that you can't make money? Sure. Feldman is saying you don't make money in the rental buildings.
I don't know about Feldman. I can't tell you what he's doing, what he's not doing. But let's go back to basic principles. What we're seeing in New York is the comeback of a city. And we're seeing demand being stimulated by people who live here, by people who want second homes here, and frankly by foreigners that will pay to own a piece of Manhattan, the centerpiece of the greatest city in the world. You're seeing New York coming back as a cultural capital, coming back, staying as a financial capital, and it's a safe, fun, wonderful place to be. And that stimulates demand, Michael.
Yeah, I remember reading a quote. I believe it was in Cranes, like on December 20th, 2001, when somebody said, David Lowenfeld said, I'm letting people leave my apartment buildings in Lower Manhattan. I'm reducing rents by 20%. 4 years, what's happened?
Well, what's happened in 20% is you see the buoyancy and the vibrancy and the tenacity of New York City. And if you want to talk about letting people out and letting people decide where they want to live in Manhattan, that was the right decision on both moral and business grounds at that time.
But we're not only talking about Manhattan today. I mean, I have Mr. Horn, who is building in Brooklyn on State Street, 199 State Street, right near Brooklyn Law School. I have Mr. Von Spreckelsen, who's building in Williamsburg, the hottest neighborhood around, which we'll get into a subject before, who's also building in Long Island City, who's building on 13th Street and 3rd Avenue, and on the other side of the river, Toll Brothers is building everything. Mr. Sigmund, who's in Westchester, who built residential apartments in White Plains, and then we have the man in Roosevelt Island. Let's talk about Roosevelt.
I think Roosevelt Island and Dumbo are the hottest neighborhoods in town.
Yeah, why? I mean, just because you have developments in those two neighborhoods?
Well, there is an interesting confluence. No, I mean, if you want to talk about a comeback, Roosevelt Island has been a great asset that has not been maximized in terms of value. And Hudson and its partner, the Related Companies, started developing in 1997.
That's a small company, the Related Companies.
You may have heard of them.
Yeah.
And we're developing a new neighborhood called Riverwalk. And it's on the East River. It's the first stop on the F after 63rd and Lex, which a lot of people don't know. They think you can only get the tram to get to Roosevelt Island. And once they realize it's part of the city subway system, that you can take the F, you can drive on, and that it has fantastic views, amazing open space, amazing recreational opportunities.
They don't accept dogs.
Incorrect. That is one of the many inaccuracies about life on Roosevelt Island. When we first started developing, we thought too that there was a no-dog policy for the island. It's not true. Every building developed up until we developed Riverwalk had a no-dog policy for its building. But when we went to the state agency that runs the island and asked them about that, they said, no, it's not a law, it's not a
so it's a building.
It's a building
specific.
by building that occurred up into Riverwalk. And we think Roosevelt Island is one of the best places in the city to own a pet. So our third building out of 9 that we developed, Riverwalk Place, is the first market rate condominium there. And it is the third out of the 3 we've done.
And probably, very few people realize that Roosevelt Island is not, it's not Brooklyn, it's not Queens, it's Manhattan. It's probably,
it's Manhattan's newest village.
It's Manhattan's newest village, and probably when you first opened the apartments there, one of the best low-cost alternatives to buy a condominium. You were able to buy a condominium at how much a square foot?
When we started?
Yeah.
Well, I mean, just to take you back a few years, we were designated in 1997 to build 2,000 apartments in 9 buildings on Roosevelt Island. And after we were designated, our first thought was, sort of the Robert Redford line in The Candidate, well, now what do we do? And it was, we didn't think that the market could support, the hard costs of doing a market rate rental or a market rate condominium. This was back in the 97, 98. So we started calling the hospitals across the river to see if they needed any housing, and we stumbled upon this tremendous demand for housing near their campuses because they were basically landlocked to some extent. And
but it's interesting. We're talking about Memorial Sloan and we're talking about the Weill College they are not that convenient to the F train, are they?
Well, it's interesting.
They're tram people, or maybe buses.
They have visions of a ferry. And for a while it was going to be Sloan Kettering, Cornell, and Rockefeller. And they were going to be the first 3 buildings. And they were going to use their critical mass to have a ferry. And they still have hopes one day of putting in a ferry. And if the ferry service ever develops any sort of consistency, Roosevelt Island would be a logical place to stop.
Speaking of ferries, David, you're building in partnerships with Ron Molis and Jay Furman in the hottest neighborhood. Everybody wants to be in Williamsburg. We'll get to Dumbo in a second because we haven't finished Condo-Mania. But so what's happening in Williamsburg? Suddenly, 10,000 units are going to come onto Williamsburg.
Well, what's happening is it was rezoned, and there's been a very large pent-up demand. I mean, people have been saying for years and years that Williamsburg is going to come around. It's one stop to Manhattan. It's got a thriving artist community, boutique community, restaurants. It's a natural place, and now a number of the properties that are right on the waterfront, one of which we have, we're going to be seeing towers that are 30 stories, 40 stories. So it's similar to what's going on the other side of the Hudson River in New Jersey, in Hoboken. It's a great opportunity.
But the reason I brought up the ferry is that I think Schaefer's Landing, they were advertising basically the ferry.
Well, Schaefer's Landing is a different location. That's South Williamsburg where there's no subway access. I think from Schaefer Landing they run a shuttle to the subway, and I think the subway is like a J train, which I have no idea where that goes. But on the north side, it's very different.
But I thought that was interesting. If you clicked on the Schaefer Landing website, which I did at the time because we thought of it as a comp to our...
For my audience, the Schaefer's
Schaefer Landing
was the former F&M Schaefer Brewing Company, which Ron Molis, who was on the show a couple of months ago, said the reason we got it is we got the land for nothing, and it was a great deal, and that was what they built affordable, the first building, yes.
But when you clicked on their website, their first images were showing the yellow taxi ferry going from Lower Manhattan to their dock in front of the building. And while it was sort of dramatic visual footage, I thought it was the wrong message to buyers because ultimately ferry service does not come at at the pace of, let's say, a subway or at any level of consistency that you can rely on taking it. It's very expensive. And as somebody who was developing in Roosevelt Island who thought that the tram was the wrong image for how to get to your site, I thought the ferry was the wrong image to get to Schaefer Landing. Needless to say, it didn't matter what I thought because they've sold out. Great, so just goes to show you.
Right, but so David Van Sprekelsen is building in Williamsburg. You're also building in the other upcoming neighborhood, Long Island City.
Right.
And David Sigmund has been designated for a commercial, but
we have no ferry service.
Right. But let's talk a little bit about Long Island City. Let's try to get some ideas on prices and what's going on in neighborhoods. What's happening in Long Island City?
You're talking about on the back end of the sell out of the condos?
In general.
Well, again, Long Island City, the Hunters Point sub-district was rezoned, creating this opportunity for housing. Queens West had been there for a long time, but all that property has been tied up. So it's an opportunity for people like us to come into the market now and find sites. It's, I think, really undervalued.
Is your site a waterfront site over there?
No, that's all been spoken for as part of Queens West, but we're one block off the water, very close to Gantry Park. On the water, you have the high-rises. Inland, you have 8-story buildings. But there's a lot of opportunity there. There's a lot of people who want to live in Queens. You're one stop away from Midtown, from Grand Central. And the prices we got for the land there we're going to be able to be very competitive with Williamsburg and other places in Brooklyn. So that's
What do you think
I'm
you'll
really
get?
looking forward to. You know, I think in my pro forma I have 650, but I think I'm probably going to be closer to 750 by the end of the day.
So for my audience, and we were talking prior to the show, a one-bedroom is what, 600 square feet?
A little bigger, maybe 700.
700 square feet. So 700 square feet at $700 a foot would be $490,000 for a one-bedroom, depending on the height and so on. For our other guests, Ken, you're developing, you've done a number of very interesting projects, which we'll talk about in a little while, but you're developing in downtown on State Street in Brooklyn. Then you're doing another project on 15th Street between 5th and 6th, and then you're doing a couple of others. What's Brooklyn going to be selling for?
Well, you know, it's interesting. When we went to Brooklyn, well, we were a little fearful, to be candid with you. And when we decided to develop there, what we thought we would do was bring the finishes that we've done in Manhattan buildings to Brooklyn, because the initial inclination was that in the event that the market would fall, there'd be a flight to quality. So if other developers were not doing as high-end a finish with your Viking appliances and your granite bathrooms and your beautiful kitchens,
it's interesting on the Viking. It's my wife. She took care of the kitchen. We did some work on the kitchen, and she put this profile. I said the Viking. She says we need special work. I said, for the amount of time that these people use these kitchens, there's really no need for a Viking. I mean, all you can use is make sure that there's a telephone to call and take out.
But that's not true, Michael. That's not true, because the bottom line is, when you're designing these units, be it on 15th and 5th or in Brooklyn, there are certain buzzwords that you have to hit when you're doing
Sub-Zero, Viking.
Yeah, I mean, there's an expectation.
Bosch. It doesn't mean people are using the appliances.
Right. I mean, look, I'll give you a perfect example. We did a building in Soho, and we did a beautiful kitchen. Viking appliances, beautiful kitchen cabinets. And I went back into one of the apartments about a year and a half later, and the gentleman we had sold one of the lofts to used his Viking range to store his shirts. So you'd open up his oven, and he had his shirts very neatly stacked. He never turned the oven on, but he would not have bought the apartment unless he could show people, look at this kitchen I have. This is a fantastic kitchen. Not only because he wanted to buy it, but because of the resale value.
We're
You need to have the good
doing a
kitchen.
co-marketing arrangement with a new appliance company based on the West Coast. Started as a commercial appliance, which Viking never did. But part of the agreement is they want to enter New York. It's a great quality appliance. It's called DCS. And so we've done a co-marketing arrangement with them where they're going to advertise our building as part of the sales of their equipment, and we're going to do the same in all of our materials. But I mean, we're trying to create another brand besides everything's Viking, everything's Sub-Zero, and if you look at repair records and everything else, on a practical basis, it's no good. On a marketing basis, it's great. And we're trying to see if we can create some new space.
Now we're going to go, we're talking about $700 a foot. David Sigmund's talking about $1,200 a foot.
Well, getting back to Brooklyn, because you let me finish with Brooklyn. But when we looked at Brooklyn, the concept of pro-forming a deal at $650 a foot or $700 a foot was daunting. Yeah. It was absolutely daunting to us to think that someone would potentially buy a two-bedroom apartment, for $800,000 in Brooklyn. So we went into the market never expecting that the prices would hit $650, $700 a foot. So we ended up buying the piece of land that we did and filtering into the development cost. We thought, prices would probably top out at $600 a foot.
But how long ago was this? Because you did have comps in Dumbo and the Heights.
But again, we're on the other side of Court Street. So in terms of looking at the Heights, the Heights is a little bit different market, and we were kind of shoved between the Heights and...
is a better...
It's a better market. It's more established. You've got Montague Street, you've got the water views, etc. Yes, we looked at Dumbo. Yes, we looked at Cobble Hill. Yes, we looked at Borum Hill. We looked at all the comps. But that being said, when we
what are the comps for new construction?
Well, probably
it's like Harlem. No, I remember I did shows. What was comps in Harlem?
You got the Lou Greco project.
When we actually bought our piece, there was a development going on right off the BQE called the Arches.
But that's a conversion.
It's a conversion.
It's not the
I understand,
same.
but looking for a new development in our area.
Boulevard East,
right?
Boulevard
East. But that's...
And that was a former rental.
Different quality. That's a little
You're
bit
in between Boulevard East.
There were no comps. So we couldn't go in being wildly optimistic. You couldn't. I mean, as a developer, you have to be somewhat conservative in terms of looking at what you develop and what you return. Yes, absolutely.
I have 6 conservative people
Well,
here?
no,
look how we're dressed.
Look, the nature of our business is to gamble, but you have to gamble if this is possible in a conservative manner.
Within the overall framework of being a scaredy cat.
Yeah.
No, I think, you know what, I think the developers today may be gamblers to a point, but they're not the developers of the 80s who were very big gamblers.
We're not doing 600-unit condos.
You're not, and that relates. And David Lowenfeld, you built the condo, finished about 1.5 years ago, the Milan.
Right.
Now, you guys hadn't built a condo in years. I mean, you'd done rentals. I mean,
Correct.
we don't want to talk about many years ago at the bad market when you built Worldwide. You were one of many people on that.
I'm glad we don't want to talk about that.
Yeah, don't bring it up.
I'll bring it up again.
Oh, we can.
We know. But let's talk about the Milan. How do you guys, who really have been conservative investors who had converted 4 office buildings in Lower Manhattan, decide to go into 55th Street and 2nd Avenue
Right.
and build there?
Well, it's important to think about real estate under 2 different models. When we look at, and I think, and please don't hold back, guys.
This is too quiet.
They won't hold back. When we build rental buildings, when we build income-producing property, we're making a long-term investment with a long-duration investment horizon. And that is really an investment strategy. When we look at a piece of land and we look at what's the process for building a building and then selling it out, what we're doing is we're really making a trade. You're building a factory to create a product that you have a chance to sell once. If you hit the market right, you do very well. If you hit the market badly, you get hurt.
So how many years?
Well, let me just finish the analysis for a second.
Us, yeah.
But what you have to do, if you want to think about that investment strategy again, is you have to think about whether you can make a reasonable return on investment on a yearly basis, taking into account the cost of the land, the cost of construction, the cost of operations, and the cost of taxes. Well, given the demand for condos, given the demand for home ownership, and given the cost of construction, because there's been a lot of construction volume in the city of late, and that drives prices up, as we know, it is difficult to see how to do a rental project for a reasonable return, which forces people to look at the condominium scenario.
So you looked at the condominium scenario. So when did you buy this land?
We assembled that land over 5 years, I would say, beginning in around, I think it was say about 98.
So you began in 98 in the assemblage, and when did you
Yes.
begin construction?
We began construction, if memory serves, in the fall of 2003.
And when did the first purchaser move in?
I would say just about 18 months later.
The beginning of 05 or 04?
The beginning of, I want to say, 05.
So that was your first purchaser. And here's
First
my
move-in.
First move-in. But I think that's a question, and it relates, and I think my audience would like to know. Who is the purchaser? Are we in a market in New York where the purchaser is buying their apartment for themselves, or do they think the term flipper? Do they think they go to the office, it's the first day of the opening, and they say, I'm getting it for $800, but next week I'm going to have some other person. How many people are flipping? Are these people moving in, Ken?
Well, we track every buyer, and we've done about 19 buildings in the last 5 years, ranging in size from 25 units to 100 units. And traditionally, I'd say between 95 and 97% of them are people who are buying to live in the units. But equally as important, we don't allow people to flip. So in other words, in our offering plans, we don't allow people to sign their contracts. So if Mr. Jones signs a contract to buy, Mr. Jones has to close on his or her own unit.
Mr. Lowenfeld?
We require people to close, but people have a right to sell once they own the
So
units.
it's
Right.
Mr. Von Smerkelson?
Same thing. So, I mean, there are flippers because they close and flip, but I think that's leveling off and almost non-existent now. I don't think
So
people
we're not the Las Vegas market.
Or the Miami.
We're not the
model.
Miami
No,
market.
no.
And what's happening is as condo prices are going up, the investor who's planning to buy and rent the yield is just plummeting
Right.
between the sales price and the rent that they're getting for the
You know,
apartment.
relating to that, Zeal owns a property, the former McAlpin Hotel, which was it's called Herald Towers,
Towers.
which you started to convert as condominiums. And you were saying prior to the show you were selling them for like $900 a square foot without fixing them up.
$950, yes.
$950 a square foot. And you said prior to the show that suddenly, after you sold 130 units, the market came tumbling down?
There's been a slowdown in the market.
Has the market slowed down or has it tumbled down?
No, it's hopefully healthily slowing down.
And what do you attribute that to?
I think there's a lot of reasons. Primarily, like stocks and like even the art world, there's a herd mentality in real estate in New York as well. We're developing in Miami, and there it's pronounced dramatically. But here, some things are self-prophesizing. There's been a lot of bad press. It hasn't helped. A lot of that does appear, hopefully, to be behind us, as a lot of my companions here have said the market has turned around for them as well. But it's primarily a result of a little higher interest rates, a lot more product on the market, and a pause.
Speaking of product, and this was when I interrupted you, David, before, you bought a property, a vacant building at 823, 825 Park Avenue about a year and a half ago. You paid $60 million, $60 million, let's round it around. And it was about 54,000 square feet?
Right.
And today you are marketing this building, which is 12 apartments, 4,100 square feet per apartment. At what price?
With Viking.
With Viking. I was going to ask you.
Julie, you need that
Although-
If you had Viking.
Appliances included is in the market.
None of our
material.
bars are putting shirts in them, though.
Yeah.
At least not
We actually have
intentionally.
closet
Staff is
space.
putting
We do have
shirts
closet space.
4,100 square feet. Tell me the price. I want
price
my
is-
guest to have a heart attack.
The prices range between $2,500 and $4,000.
So that means
A
10
foot.
million
A foot.
A foot. That
10 to
means
16.
10 to 16 million dollars.
Right, finished, beautifully renovated on Park Avenue. A condominium, which is another rare.
Condominium on Park Avenue is definitely a rarity. And how many units have been sold?
We have sold 4.
It's better than Siami's doing.
Yes, Siami is the property down in the seaport. But but that's the top of the market. And I think what we're saying is there are different markets for everything. I think what David Sigmund was saying before, there's a definite market on the Murray Hill market. You have the students, the graduates, and other things,
Hospital
and the doctors,
employees,
the hospital employees.
Yep.
You have Chelsea, which is a little higher up. Ken Horn was saying that at the Sutton, which we'll discuss in a second, you have people who are in the 40s to 55. David Lowenfeld in the Milan, what was the average age of the purchaser?
We had a really mixed group. We had people who were a little bit older than your purchaser who lived in that neighborhood at around 55th Street. We had empty nesters, I would say 50 to 65, who were moving in from the suburbs. And we had people from all over the city, 40s to 60s.
And it's interesting. I know that there were a number of units that were bought by people who have rented them now.
Yes,
in your
there are.
building. In your building, a substantial number of people wanted to buy. They might have wanted to buy it as an investment, and now are renting the units, hoping that perhaps the market will go up and so on.
That's correct, or thinking that they wanted to mothball it for their own use at a future point in time.
We've also seen rents move up, though. I mean, that's the other part of this is, there's this math that people do of buy or rent. And what we've seen in New York, which you haven't seen in maybe Miami or Las Vegas because the rental markets don't exist to the same extent, is that post 9/11 there was a big fall off in rents, and those rents have come back very, very strongly.
Yeah.
So we actually can do a yield analysis for our pension fund investors that says, worst comes to worst, you have to put these things on the market with 421A taxes. We can show a reasonable yield to these guys.
It's interesting because, as you stated before, most of the properties that were built in the former Flower District were all rentals.
Right.
And they started probably in the in the 40s. The Albaneses who have been on my show said that they expected to get 40s, 43. And then Matt Adele said before he sold the building that he was getting as high as $60
Yep,
a
and we're
foot.
seeing that across the street on 34th Street as well. The Anthem is getting rents in the low 60s as well. And that's become kind of the price point for,
But
for
if
new
somebody
rental
is getting
projects.
rent, and for my audience, if that means if you have a 700 square foot one bedroom at $60 a foot, that's $42,000 a year. $42,000 a year is $3,500 a month. Now that relates to perhaps something that you're saying in the sale of your units and your units. If someone's going to pay $3,500 a month, what can they buy for $3,500 a month?
Well, that's a typical analysis that a buyer is going to do. A buyer is going to sit down and work out what his common charges are going to be, what his real estate tax is going to be, what the interest is going to be, what the deductibility factor is going to be, what tax bracket they're in. They're going to look at what the net number is to carry the unit, theoretically, how much equity, how much money they have to put down, and they'll make a determination whether or not it's a good investment. Now, that doesn't always have to equal, because you have the concept of home ownership, where someone may say, you know what's going to cost me $200, $300, $400, $500 more a month.
People want a piece of the apple.
But I will own. And I'm not taking my rental money, per se, and throwing it away. I'm developing equity. I'm hopefully going to buy an asset that's going to increase in value. May cost me a little bit, but I get the tax benefits of ownership.
When we looked at 24th Street, we specifically sized the units so that they were clearly a step up from the rental units that are right across the street. And Matt Adele's building is the nicest building in the block. And we looked at that and we said, you know what, we don't want 8.5-foot ceilings. We want at least 9 or 9.6 in the case of 24th Street. We want a better kitchen. We want better bathrooms. We want, slightly larger living spaces. And it ends up being, on a gross dollar basis, a slightly more expensive unit. But when you own it, you say, this is clearly something that's a step up from what I was living in before. And it's close enough that it's not a hugely different math, but it's something that's clearly better than where you were
But
before.
I want to pick on what Ken was saying before. I think that the investment value of real estate across the board, for institutions, for pension funds, but also for individuals, has become much, much more important over the last period of time. Number one, alternative investments have just not done well. There was a time in the late 1990s the stock market looked like the best thing you could possibly do. It's not the case. Real estate right now is considered a good investment category. Number two, after 9/11, especially in this city, people said it's not time to defer enjoyment. It's time to trade up. It's time to take advantage of it. And you know what? If it's our savings, it's the best investment we've ever made. If it's my retirement savings, I'll move somewhere else at retirement. But meanwhile, let me live in it. Let me enjoy it. I don't get any nachas from my monthly statement from my broker.
Who's buying? Who's buying, and how are they affording to buy?
Well, I think everybody's buying.
No.
Across the board, everybody's buying at every
How
income
does a
category.
young individual buy an apartment? You're building the J, right next to the Brooklyn Bridge in Dumbo. You're building, we've discussed all this. It's a 30-year-old person or a 25-year-old person. I heard that it's $1,000 a foot. And somebody maybe they'll buy a 700 square foot apartment, but as you know, they want to buy 1,000 square foot. They want to have it so they can have room for their child or something over there. They want a little bit more. That's $1 million.
But I'm not sure that people, and you guys can disagree with me, I'm not certain
I
that
hope you
people
do.
are pressing themselves financially. We haven't seen that anyone trying to leverage up to the eyeballs to buy these units or to put themselves in precarious financial situations. I mean, our market, say, on most of the projects, people between 30 and 40, they're not leveraging themselves 90%. They're doing it 75%.
If you look at affordability, you can't ignore the interest rate side of the equation. So you can't just focus on the gross dollar purchase price. You have to look at what kind of mortgage these people are getting. And if you do it at a 6.5% 30-year mortgage, which not everybody is doing that, but the affordability hasn't really changed that much. And if you look at what's happened to incomes in the law industry, incomes generally in New York, and don't take you have to slice the data the right way. Don't look at gross numbers for all of New York City. You have to look for who are the white-collar people that are working in Midtown Manhattan or downtown, and you have to understand what's happened to their incomes. Their incomes have moved up pretty well. And with the lower interest rates, affordability is still there.
And actually, developers don't want the buyer to stretch too much when they're signing the contract because they want that buyer to close. And in the case of J Condo as an example, we are signing contracts where the buyer does not have a financing contingency and the closing is 18 months out. And we ask that buyer to go get a pre-qualification letter from a mortgage broker. And we have 2 mortgage brokers who we're working with, and we add a cushion to the interest rate to make sure that they qualify at a higher interest rate, because we want them to close in 18 months or in 15 months and not have the interest rate risk when it's time to close.
I mean, but as Mr. Lowenfeld said before, you're taking the asset and you're selling it. You're not keeping it for the long term. You know, you're making your money, you're taking the risk, and you're not looking at the long-term situation.
I think most condo developers would prefer to do rental buildings. There's less litigation risk. It's easier on the scale of agita, and you do have a long-term hold. I mean, we've done condominium projects, and 3-4 years later, you know, we sort of look and say, wait, what happened to the money we made from that project? You know, as opposed to a rental building where you have cash flow every month and every year. And the answer is that, you know, we sort of joke that the definition of a condominium is a project that doesn't work as a rental.
Right.
David L. was talking about the Milan, which he assembled in '98, which had to be a condo. I mean, in '98, people could still do rentals. Today, there's not one project in the city that can be a rental.
So
we tried to assemble that building as a rental, and what ended up happening is that we were able to get the corner, which made it a much better building, but made it unaffordable to do as a rental.
Yeah, but the methodology of analysis has changed, because 7-8 years ago, a lender would not necessarily lend to a developer, maybe 10 years ago, to do a condominium unless there was a downside rental scenario.
That's correct.
Right? That's
Every lender
Right,
wanted
but
to make sure that if the property didn't work out, you can always rent it.
Right, but that's changed now.
But then they
because-
wanted to get the deal.
Right, but that's changed, exactly, because now,
doesn't
if someone's
pencil.
buying a building and their exit strategy is to sell it for $1,100 a foot, there's no way the thing works as a downside rental scenario. So to a certain degree, it's not only we as developers who believe in the market, it's the lenders, right? It's the equity participants, it's the pension funds. They all believe that the condo market has got wings. If not, they would insist to a large degree on looking at a downside rental scenario. What's your exit strategy, Mr. Developer, if you can't sell them as condos?
And home ownership isn't just a New York or Miami thing. This is nationwide, and it's a statistic that's been relatively steady for a long time and then started lifting. And so it's a big wave. This isn't just, condos in New York. This is home ownership nationwide, where we're just one piece of that picture.
Right. Zio, you've bought a lot of rental buildings. You went into business in the early 90s, and you've acquired 20,000 units, 15,000 units over the years. And you've kept some buildings as rentals, correct?
We have just a few, the ones that were not really candidates for conversion.
But you've tried to convert most of the
Everything,
buildings.
sure.
And you know, something else that you've done is you've bought, as we would say, rooming houses, SROs. You bought a hotel which was on 57th and Lexington. You bought a hotel on 76th in Amsterdam. And
76 and Broadway.
And Broadway, and then you bought the old Martha Washington. On otherwise which you changed to 3030.
3030.
Now, these are properties that are hotels today. Ken Horn, 6 months ago, bought a beautiful, classy hotel, the Sutton, that he's converting. Why haven't you converted your property, these hotels, to rentals or condominiums?
Actually, now the trend is moving back to hotels, as the hotel market in 2005 has surpassed its peak in 2000, pre-9/11. So it didn't seem like a great idea. In fact, it was a very expensive, terrible hobby in 2000, 2001 to own a hotel. But now you'll see a trend, and a lot of banks as well are shying more away from condos based on certain underwriting criteria and are encouraged by the hotel market.
So you're saying the hotel market, which I believe is great, and it happens to be the topic of my discussion, my article this week in the Sun, is doing great.
And the more hotel rooms that were eliminated by condos, the greater hotels are as investments in Manhattan. I mean, we're basically under-roomed in Manhattan and in other big cities in the country.
Yeah, I mean, Manhattan has 70,000 rooms. Las Vegas has 145,000 rooms. And, you know, over the last 5 years, we've lost about 3,500 rooms. And we're not building them up. You know, when Sam Chang builds a Hampton Inn with 120 rooms, it doesn't increase the number that fast.
But now we have condo hotels. You have the best of both worlds.
You know, that's an interesting. What's a condo hotel? I mean, this is not my hotel show, but Mr. Horn took the Sutton.
Which was never a real hotel.
It was really an extended stay.
An extended stay facility with a residential certificate of occupancy. It never had actual permission to be run as a per diem, 1 night, 2 night stay hotel. So when we bought it, it was actually built in 1929. From 1929 to 1970, it was always run as an extended stay facility. 1970, it became vacant. It was vacant from 1970 to 1990. I mean, believe it or not, a building like that on 56th Street just sat vacant, became derelict. In 1990, a Hong Kong company bought it and basically spent $35 million renovating it. But
it's always good for those nice foreign investors to put money into New York City.
But the building itself was never a quote-unquote true hotel. You know, nothing like, like 3030 where you have per diems and things along those lines.
I mean, in many of yours, they don't even have bathrooms. I mean, there's a bathroom.
They didn't. Now they do.
Oh, now you
with Viking ovens and
Viking toilets.
Viking toilets, yes.
People store shirts in those as well.
But you know, let's talk about the different areas of the city. You know, out of nowhere, and as I started the show, you know, their parking lots are gone. You know, churches are leaving the place. I mean, you're buying a property, you're building a dormitory over there. You're buying a church, you're building an apartment house over there. You've bought property, I mean, you've been really interesting. You bought property in the Bowery when the Bowery was nothing.
Right, well, the property we did in Bowery, we bought a gas station in the Bowery, and we built a very high-end condominium on Bond and Bowery. And one of our buyers, a young man bought, and he was telling me his father said to him that he spent his entire life trying to get out of the Lower East Side.
Yeah, I had that in one of my articles, yes.
Yeah, it happens to be true. This kid told me that his father was furious at him that he wanted to buy on Bond and Bowery.
Back where he started.
Back where his father started. But, you know, there was a retrade in that building recently, something like $1,400 a foot.
You know, talking about parts of the city, Mr. Lowenfeld.
Mr. Stoller.
You went in and you took 71 Broadway, the former U.S. Steel headquarters.
It was.
And then you took 88 Greenwich Street.
Yes, 19 Rector became 88 Greenwich.
And you took these properties and you acquired them at a reasonable price.
Yes. And
you made them rentals. Why did you make them rentals?
Well, we made them rentals because we as David said, every condo developer would rather be a rental developer because we could. The second piece of it was that because we were coming into an area that was unproven residentially at the time in Lower Manhattan, it was important to us to be able to have an investment period that would allow the market to establish itself. We didn't
but fortunately, the administration gave you some tax advantages.
Absolutely. Without those tax advantages, nobody would have done anything. That was one of the greatest programs done by the government. Look how many units are downtown today. Look how we have a 24-hour city today down there. It's great.
Unfortunately, I'm sitting here with people who aren't really building in the Lower Manhattan area. Why? Why aren't you building in Lower Manhattan, Mr. Kramer, or Mr. Sigmund, or the Toll Brothers? You know, or you really aren't really in Lower Manhattan, the financial district?
I've never been a believer. You know, I think that you see a lot of sites as a developer, and you have to pick and choose where you're going to focus because each project takes up 3-4 years.
Focus. You're in Rockaway. You're all over. You know.
Right, but you're in areas where it just sort of, you know, there has to be some. It's not just numbers. It's not just pro formas. At some point, you have to have some vision, some strategy. It has to feel right. We never felt right about residential on Lower Manhattan. Now, of course, we were completely wrong. We've been completely wrong on. You know, we should have done every project we looked at over the last 10 years. We passed on Toll Brothers site in Long Island City. That's why I was curious to see what you're planning to sell it for. And we were just never believers in it.
And what about?
Well, so much of Lower Manhattan is really just dark, and it's places where I wonder if people would really want to live. I mean, there's some good sites, and we're looking at sites right now. I'm not saying we'd never do it, but there's, I think, a limited number of decent sites.
Well, the other thing, we looked at a building recently down there which had spectacular water views. Unbelievable. But it was an office building that was probably built in the mid-'80s, and on any given floor, you had 12 elevators. Right, so the loss factor was enormous. So you're buying gross square footage, but you can only sell net square footage. So as opposed to buying a residential building that you're either going to build from scratch or buy a warehouse building that you could theoretically put the elevator where you want, here you were buying, say, hypothetically, a 50,000 square foot floor, but you can only sell 30,000 feet. So economically it made no sense whatsoever.
But Michael, what these guys are really saying is they have to work where they're in their comfort zone. You have to feel there's a margin of safety in what you can sell for or what you can rent for. You have to feel like you're not stretching to the limit unless you're so confident that the market is there that it really is just a trade. If you have a building that you're doing as a dorm and net renting it to a hospital or a university or something like that, that's a different calculation. But when you're going in and you've got a big loss factor and you don't know exactly what the market is that it might be soft when you have to come to market, you don't have that margin of safety. We're not in our comfort zone there.
There was a piece in the Times about have we moved away from location to just image, and I think we're probably all saying absolutely not. We all do analysis based on what's going on in that location. And for Elcor, we really came at it only really wanting to be a rental developer and got into the condo market because of how the economics were changing. But the decision we made was almost what a suburban developer would do. We want to be near jobs. We want to be near transportation. We want to be near retail. And unless you could check all of those off, we weren't going to be comfortable. So when we looked downtown, we didn't see enough retail. We didn't see enough job stability downtown. We were concerned about what was happening with the Trade Center site and how that would affect values. And yeah, there were deals to do down there, but we just felt we weren't comfortable. So it was outside of our zone. Our zone's pretty narrow because we're relatively new to the market. So we're staying to Midtown, where we know there's jobs and access and retail. All those services are there. So even though we're paying a premium price to get into that market, we felt it was less risky because we knew the market was going to be there. Even if the market contracts, historically it contracts.
If someone had asked you, what's the best next location? If someone wanted to find an apartment and they wanted to buy, because I always get that question, and I have to go to professionals like you for this answer. Where would you say? Are we talking, as Barbara Corcoran said on ABC, is it the South Bronx?
Well, it's funny.
Is it Harlem?
When I'm interviewing people for jobs at Hudson who are just out of school or in their, let's say early to mid-20s, I ask that question. I say, okay, you have your finger on the pulse of what's going on. You're the one checking Craigslist. What's the next hot neighborhood? I figure even if I don't hire the person, I may get a good tip. And the answers I've gotten are Windsor Terrace, Prospect Heights, Bed-Stuy, the 3rd, 4th Avenue corridor. I mean, those are all Brooklyn neighborhoods.
Gowanus Canal.
Gowanus Canal, as he puts in a little.
There's going to be product everywhere, though, Michael. I mean, that's
part
of what's going to happen in 2006 and 2007 is that you're going to see product all over the city, conversion.
The question is, I think Howard Rubenstein spoke about a year ago, or a year and a half ago, at a RealShare conference, and his comment was, there are no bad neighborhoods in New York City today.
And I'll give you an example of that. We have an affordable housing division. And we're out there looking for development sites for affordable housing. And the price you can pay for land to do an affordable housing project with HPD, with tax credits, it used to be $10 or $15 a foot. Now it's gone up to $30, $40, $45 a foot, and still make the project pencil with tax credits and different subsidies. And so many of the sites we've gone after, which were sites where you thought, there's a parking lot in a rough area where you think, okay, here's a site where we could probably put together a project that would work as a tax credit project or as an HPD project. Somebody else is outbidding us for a condominium project, and there seems to be no limit as to where that neighborhood is. Where we would want to buy a site for $35 a foot, somebody is buying it for $70 a foot because they think they can sell condos for $350 a foot. And
that's right. The difficulty in the inclusionary in the Williamsburg rezoning is that people are going out to East Williamsburg. It's too expensive there. They go out to Bushwick, and now it's getting beyond the area, the band where you can do the inclusionary. So I think it's going to be really difficult for developers to incorporate the inclusionary in their programs.
For my audience, explain what an inclusionary. Who would like to answer that? The king of inclusionary, one of the Davids.
Well, inclusionary housing is a program that's described in the New York City zoning resolution that allows developers to build market rate if they build inclusionary within a certain area. Usually it's within a community board. So you build affordable housing that has restrictive covenants in perpetuity to develop affordable housing in location A, which then creates development rights in location B, so that if you're building in Williamsburg, you have to look for an area within the same community board to build the
and you're able to build a
housing.
higher building in many cases.
Yes,
a
it
taller
increases
building
the,
where
Even
we'll
if you're
give you a
building
higher
luxury
price, you know. And
Even if you're building luxury, you can feel good about yourself.
yeah, that you are doing something.
Exactly.
And, I know many inclusionary developers like yourself who do feel good about this because they're providing affordable housing for the working people. You know, you pick up the newspaper every day. I mean,
Usually it's the New York Sun.
no, it isn't. You pick up the Sun on Thursdays, and you see in the papers. I think there was one blurb saying that in 1 month there were 70, maybe 150 times they said the bubble, the bubble, the bubble. Are we in a bubble, or are we in an adjustment? Zeal, you said prior, we're in
an adjustment.
We're in adjustment. Mr. Horn said before he started Sutton East, he didn't in December. You're not an adjustment.
No, I didn't say that.
Oh,
I didn't say that.
oh, please!
well,
we have about 10 minutes
I
left.
didn't
I
say
really
that.
want to answer this
No,
bubble.
I didn't say that.
This bubble
What I said is
concept.
that what I'm using as a basis of comparison is we did a project. We opened up a project in Chelsea. We sold it out in 4 days. This was in April of 05.
So in April
Of
of 05,
05,
how many units?
That was a good time.
67.
Spring
Yes.
05.
Right. It was April of 05. We had 850 brokers at an open house. We had multiple
Those brokers
bids.
give them food
We
and
had- we
other
did,
things?
and giveaways. But we had multiple bids for every single unit.
What were your giveaways?
We gave away food. We gave away little coasters.
right.
But
Okay,
a lot
get
of food.
Talking, we have,
a lot
we
of
have,
food.
we have J Condo chocolates.
A lot
we
of
have
food.
hats.
We'll bring that next
but you
time.
know
When
what?
the Sooner Levines, we give silver cup shirts.
The concept of selling real estate, like he was selling hot dogs, just didn't sit well with me. And look, it's great. We'll do nicely on the project. We're happy we eliminated a risk. There are all different risks when you develop property, market risk being one of them. But that's not healthy.
Where
it's not a
are
healthy
we?
market.
My team are telling me I
That's
got
it.
5 minutes.
We're
Are
reverting,
we,
we're reverting
in
to
an-
mean. We're going
Right,
back
exactly
to,
right.
to an
I mean,
ordinary market.
When you have a 60.
So this crazy market of saying I'm going to get $1,200. I'm going to change the price next week to $1,300 or $1,400 developers.
Look
Is that
at
happening?
the pricing over time. Go back to the 1970s if you want to, and look at the trends to what's happened to pricing. And it bellied out, during the black days of the 90s. But then it came back up again. And if you follow that line, it's a pretty straight line. So we went above it for a while. You're going to come down, but the trend is still there. Trend hasn't really changed.
I mean, bubble is the wrong concept. It's too, real estate in general is too illiquid to burst like that. I think if you want to talk about the concerns that developers have, speaking for myself, it's supply. Supply is the big concern, I think, going forward. There is a tremendous amount of new product that's in the pipeline.
So basically,
buyers are very
so what you're
sophisticated.
saying is the buyers are more sophisticated. I think Zeal said prior to the show, and I think Ken also stated that people are taking a little time. They're making a decision, but they're not making a decision immediately.
And
as
not
opposed
only
to-
that,
to-
Yes.
in our condominiums now, we're very sensitive to how many pricing increases we have, how many amendments there are to the AG's offering plan. Because I think when buyers come in today and there's all of this talk about the bubble and there's lots of product and they see that you're on the 14th pricing amendment, I think that's a real discouragement. So we try and sort of consolidate our pricing increases and minimize them. But I would say instead of a bubble, it's a concern about supply. There's a seasonality to the market. November and December were very slow for the condo market, but that doesn't mean it's a bubble because most of the sales volume occurs in March and April, year in, year out. But if you
hence the 850 brokers in April.
right.
Right.
But if you look at the most recent numbers for fourth quarter 04 and compare them to fourth quarter 05, you look at inventory and number of sales, not price per square foot, but number of sales. Fourth quarter 04, there's about 3,000 units in inventory, of which there were 2,000 sales. In fourth quarter 05, 1,500 sales on an inventory of 5,000. So the ratio of sales to inventory from fourth quarter 04 to fourth quarter 05 really plummeted in a way that gives one pause.
So if I can sum this up, you're saying we're in an adjustment. We probably won't see. We'll see an apartment that may be in a condo, which if somebody prices it like you're going to price your properties maybe at $1,200 or $1,300 a foot in Manhattan, or you may do Long Island City at $700 a foot. And yours will stay over there. We're not going to see these rapid increases to the next $200 a foot. Am I correct?
The key is to look at neighborhood. You have premium neighborhoods in New York. You've got
Like Zio's Park Avenue.
You've got the Upper East Side in the 70s near all the private schools. You've got programs on Central Park West.
Riverdale?
Maybe Riverdale. Those are premium markets. And those markets have tremendous pent-up demand, strong barriers to entry, and when product comes on in those neighborhoods, they will sell at a premium, and they will develop velocity. But you have no bad neighborhoods in New York now, and in those markets, a buyer can make good buys.
Question. Last question. I'm a buyer. Should I buy or should I wait?
People have been asking that. People have been thinking that they should wait for the last 8 years, and everybody who's waited, regrets it.
And Norman Sterner spoke today at National Realty Club, and he was talking about the commercial office market, and his comment was, if everybody was waiting, we wouldn't have sales.
Well, if a buyer sees a property that he or she
you want
likes,
it, you buy it.
No residential buyer should try and time the market.
You live in the property.
I agree. And everybody we see are living in the property. I'd like to thank my guests today for appearing. David Lowenfeld, Worldwide Development, Ken Horn, Alchemy Properties, Zio Feldman, Property Markets Group, David Von Spreckelson, Toll Brothers, David Sigmund, Elcor, and last but not least, David Kramer of the Hudson Companies. Next month, we're going to be talking about the office market, and beginning March the 6th, in addition to this, we're going to have another show called Building New York, where it's a one-on-one with the people who build New York. Thank you.
Funding for the Stoller Report is made possible by a grant from the First American Title Insurance Company of New York. The First American Corporation is the nation's leading diversified provider of business information products and services that impact the major events of people's lives.